Hey, welcome everyone to the session on how to invest in times of crisis, brought to you by the Kotak Alumni Association. I'll be your host and moderator for today. My name is Rahul Gaitonde. I'm the Chief Operating Officer of the wealth creation firm Cube Wealth. On the panel today, we have people who are extremely relevant to the topic at hand. Nitai, Utkarsh, Lead Investment Strategy and Chairman's Family Office, Hero Motocorp, Class of 2006.
Hi guys.
Sandipan, Director and Lead Products, Credit Suisse, Class of 2006.
Yeah, hi guys.
Sandeepan, Harish Krishnan, Senior Fund Manager, Kotak Mahindra AMC, Class of 2005.
Hi, good afternoon.
And Sandeep Reddy, Founder of Real Estate Data Analytics firm Propstack, Class of 2006.
Hi everyone.
So the structure we'll follow today is we'll have each of the panelists introduce themselves. We'll talk about each of their individual investing approaches. Then we'll talk about how investing has changed in these interesting times. And move on to asset allocation, building a portfolio. We'll close with the panelists' views on where the macroeconomy goes from here. We'll take a few questions from the audience. So do add them to the list during the session. So a couple of important things before we begin. One is do contribute to the IMK Alumni COVID Relief Fund. The link is right in the description. We've raised a significant amount in a very short amount of time, but the bar can always be higher. Do subscribe to the IMK Alumni YouTube channel. We've had great sessions in the past and more coming up, just like those. Finally, given this is the session, given the topic of the session, I do want to point out that the views expressed by the panelists are their own, not their organizations, and do not constitute investment advice. Nitai, you want to go first?
Hi. So my name is Nitai Utkarsh, and as Rahul introduced, I'm from the class of 2006. I lead the family office for the chairman and promoters of Hero Motocorp. Been in the wealth management family office space for ever since I got out of IMK. I think the focus for me will be more of an allocator perspective. When you talk about investments, how do you really allocate between different asset classes, between different investment vehicles? So that's really something that I work with.
I am Sandeep, batch of 2006. Been running this company called Propstack for the last 6-7 years now. It's a leading real estate data and analytics firm. Prior to that, I used to run another real estate startup called Groffer, which was into group buying. Incidentally, I started that company just after the financial crisis, and seen the real estate cycle since then. Even before that, I was a real estate analyst at Kotak, wherein I worked on a lot of real estate IPOs. So I have seen real estate cycles for the last 12-13 years. We will be sharing my tidbits on real estate sector.
Good morning, everyone. This is Harish this side, class of 2005. I've been with the Kotak Group for the last 15 years. I've been handling offshore money for about 7 years. I was based out of Singapore and Dubai. And the last 7 years, I've been based out of Bombay, where I'm handling the domestic mutual fund. Thank you.
Yeah. Hi everyone. This is Sandipan and a class of 2006 again. I have been on the asset management side of business for quite a long time now. Started with ING Investment Management as an analyst, moved to UTI Mutual Fund. From there, went on to co-found ICICI Securities Private Wealth. And now I'm working with Credit Suisse as the head of products in the private banking India division. So that's about me.
Let's get into part one of the session, which is really views on your own personal investing approach. So just want to start with Harish. You've been effectively, like you just described, a fund manager at Kotak AMC. How is managing your own money different from managing funds?
Okay, tough one, and honestly, let me give you a bit of a background because there is this misconception that people in the finance industry know better to manage their own personal finances, and I think there cannot be a bigger example of somebody who doesn't do that, and that is me. I still have money lying in current accounts somewhere in Singapore. I have about 4 or 5 bank accounts which are dormant for the last 15, 20 years. So really, it is not so much about having everything correct as a professional investor would have liked to see. So let me give you a small background and possibly take you through the conflicts of personal investment and professional investment in a nutshell. Uh, So, when I started my career in 2005, and clearly those were the good times. We've seen prices move up almost every second day. And then, obviously, as we all know, 2008 and 9 happened. And till 2010, 11, I had very little money in equities. Most of the time, I'm a very conservative person by approach, and I was very happy. And I used to stay in Singapore at that time. The only thing that actually I kept on doing was to send money back into India through my NR channel. And till 2010-11, it was very good. And that is when it suddenly struck me that I'm doing a great disservice to my own wealth, the way I've been managing. And this realization I got when I actually saw my father's demat statement. For some reason, he opened up it to me sometime in 2011, saying that you are managing others' money. Why don't you try and manage mine? Or why don't you advise as to what I have done so far? And it really opened my eyes that someone who had very little financial literacy, who used to make say 1,000 rupees a month salary in the 90s, had actually amassed a significant amount of wealth investing into mutual funds. And that is when it really hit me that whatever we are speaking about, that it's all for the long term and all that actually works out. And this was my first real experience. And of course, I had done some ELSS investments in 2005, 6, 7, and then I happened to see it, and then I really understood the power of compounding. So sometime in 2012, 13 is when I got really serious about my own personal finances. And that is when it really started, adding proper asset allocation, meeting a lot of people in the wealth management industry, seeing my own finance professionals around, gave me that kind of a yardstick. Now, very quickly, to kind of sum it up, the difference between professional investing and personal investing. I think professional investing, most of our time goes into, timing. We are looking at when the next up market will come, when the next down market will come. Whereas, personal investing it's not so much about, finding that extra bit of returns. It is always about asset allocation, which invariably, as professional investors, regardless of how much, bearish one is, if you keep getting a lot of money, you will start investing, you will try and moderate it, etc. So I think that is the difference. I would say the horizons are different. So that is the one conflict that is very difficult to manage as far as I'm concerned from a personal and professional investment point of view.
Nitai, how do you manage your personal family office, so to speak?
Well, I think I've been fortunate in the sense that the professional role that I play is very similar to what I would do as an individual, except of course when it comes to scale, because when you're looking at advising a family on their investments, it's not really managing a fund, and you're really looking at putting yourself in their shoes and trying to understand the various behavioral issues when it comes to investments and advising them on the basis of that, rather than pure investment logic. And I think that's something that works when you are looking at investing as an individual as well. Because one thing that I've realized over all these years is that more than any kind of investment logic, what is more important is how you take to investments, right? You as an individual. So everybody's approach to investments is going to be completely different from the other person's, and that's something which is a common trait between my professional and my personal role as an investor. Uh, but like I said, the scales are different. So when I advise a family office, we are talking about crores of investments. When I'm talking about my own investments, obviously it's far lower. How I wish it could be higher, but as of now, it's far lower. And so one has to take decisions in terms of what kind of product landscape is available for me to invest into. And then what's my risk profile, what are my goals, what is my asset allocation looking like. So in all those respects, it'll be different. But like you said, the basics are necessarily the same. There is not too much difference between investing professionally and investing personally, for me at least.
Sandipan, you want to talk very briefly about sort of how you manage your own money versus what your day job entails?
Yeah. So, obviously there are professional restrictions for us, investment professionals. We are not allowed to invest or hold on to our, let's say stock ideas, etc., for a far longer period than we may want to at some points. But having said that, or are there a lot of approvals that we need to take? So that obviously restricts our investment universe. Having said that, professionally, what you are doing is managing other people's risk. When you are in ultra HNI wealth management space, you are basically managing risk rather than returns. They've already got rich. Your job is to preserve that wealth and optimize their risk-adjusted return. When it comes to your own personal wealth, again, it becomes a function of your own risk appetite, and you tend to obviously as Nitai mentioned, being in the profession, it helps. So I am fairly analytical in my approach. So I believe in asset allocation a lot, given the way the investment cycles have shortened and the way the asset classes have started behaving. So I believe in asset allocation, and hence you tend to gauge your own risk appetite and how far you are willing to go, and you manage it accordingly. So I do that, and I think the best investment class for a salaried individual at the end of the day is the individual himself. So you try and invest as much as you can in yourself, be it health, be it wealth, be it professionally, and be it personally, and that I think matters the most when it comes to your personal investment management.
Okay, tremendous, tremendous. Risk and asset allocation are something we're going to be getting to very, very soon. But Sandeep, what's your approach looking like?
So, unlike other panelists, I am not in the business of giving investment advice as such. I run a startup, and as Nitai said, everyone's risk profile is completely different, and their investments will also mirror that, right? So, I have been running a startup or multiple startups for the last maybe a decade. So, I think that's the biggest equity risk that I'm taking, investing in myself, and that becomes the major asset class as such for an entrepreneur, I guess. Everything else, is like anyone would do. Look at equities, look at gold, look at real estate, right? And that's where the remaining wallet share goes into.
Mm-hmm. Mm-hmm. Okay. Okay. Interesting that two of you have said investing in oneself is important as well. So, okay. So one of the things that I've seen myself, having heard you guys, one of the things that I see in on a day-to-day basis, because the company that I run, Cube Wealth, manages effectively brings HNI class advisory to the mass affluent. So a lot of our customers look like IIM Kozhikode alumni. In fact, some of them are IIM Kozhikode alumni as well. But so one of the first things we see is often the basics. So Harish, you talked about the basic principles of investing for the long term systematically. But a lot of the prep work that we expect most individuals to have done, which we think is common knowledge when it comes to personal finance, is often missing. which is that a lot of people don't have an emergency fund on hand. They aren't saving systematically towards, say, their short-term goals. And long story short, they end up using their investment kitty as something to draw upon whenever expenses arise. And so when markets are great, they become profligate and end up spending more than they could because their kitty is growing. But in times like these, when markets drop, then they panic needlessly. And so one of the first things we do is, regardless of how advanced the service it is that we offer, these basics are really what's important. It's something I try to follow. It's something I guess most of our customers are pushed to as well. Anyway, speaking of markets falling, let's the next thing we have on hand is really investing in interesting times. Harish, how has fund management changed?
So I think in many aspects it hasn't changed, and that really is I think what is the basic. And I just want to take you back. When I was, for example, in Singapore, and one of my clients used to be the Swiss bank, and of course not the typical Swiss bank that we talk about, but there used to be a wealth management firm called LODH. And they are one of the original Swiss banks, or the 4 original Swiss banks in the world. And when you go to their offices, they've got this ledger, okay, and in that ledger, every day or every week, I think they move a page of the ledger. And the ledger goes back to 1600 and 1620 and 1650 of how a ship has moved from, say, Tunis to Alexandria and all of that. This really is, I think, symptomatic of the fact that money management at the heart is very simple. We try to complicate it, and it is ageless. We try to complicate it by introducing terms of alpha, beta, gamma, quants, all of that, when all it needs is common sense. Of course, that doesn't mean that it is static. You have to move. So speaking personally, how my fund management has evolved over the last 15 years, I would say that I can think of 3 distinct changes that I have seen in my own approach when I started out. The first approach is what is called thumb rule investing, and I see that often, for example, even in our own IMK chat groups, etc. Everybody wants a thumb rule, right? Heuristic based approach. Oh, P is so cheap, let me get in at 10, 12, 15. It's as if that's some Lakshman Rekha drawn in the sand, that it shouldn't go below this or above this. And over time, markets teach you that there is no such thing as a thumb rule based investing. It is always better to go from first principles. And the more you go from first principles, the better your investment decisions will become over a period of time. And this applies to individual stocks, it applies to asset allocation, it applies to sectors. So that is one clear change I've seen over the last 15 odd years personally. The second thing, in a way, is related to the first point, is that when you start out, your focus is always on the P&L of a company. Invariably, ratios like PE ratios get bandied about, earnings, profits. I was fortunate enough, very early in my career, to be to have reasonable interaction with our founder, Uday Kotak, and in one such interaction, he said, most people make a mistake of looking at profit and loss statements. The real focus needs to be on the cash flow statement and the balance sheet statement. So the moment you start moving from the cash flow, then to the balance sheet, and then the profit and loss becomes a residual portion of what comes from it, a lot of things fall into place. You are not obsessed with profit numbers anymore. And the third, to add, is when I first entered this field, it was always about demand. Oh, this industry is so underpenetrated. Oh, there is such a huge population, and partially, I think the fund management industry is to blame. For countless years, we have been peddling the same slides of underpenetrated consumers. The median age is 25. Ever since the last 15 years, the median age has been 25 in India. I find it quite shocking how that can be the case, but it still is, right? And over a period of time, you realize that the actual value of a company or a sector is not on the demand side, it is on the supply side. And the more people get this, that focus on the supply side, because in India, especially in India, which is young, underpenetrated in almost every other category, the demand will fall into place. It might take 3 months, it might take 6 months, it might take 1 year. There isn't ever something that we are forever going to be in a demand slump. But when you're looking at the supply side, a lot of things become clearer. Are there only three firms in a sector which account for 70-80% of profits, or are there 25 firms which account for that? And that will have material implications as to what kind of multiples and what kind of valuations you are willing to give and back the managements. So I think these are the three distinct phases I see personally when I look through in the last 15 years of what has changed, while looking at the same set of companies over the last 15 years.
Got it. Okay, so actually, this is something we might actually tackle during this round itself, because I think there's also a question from the audience about first principles, because there's a lot that's been written about heuristics, but what about first principles? So, Sandipan, you want to talk about what you think are first principles that you hold to be true?
So a very interesting question, and I think to each person again it becomes a different interpretation altogether. Um, we have been taught finance from American books, and we have gone by CAPM models, and learned more about quants, and we have all of us. I mean, almost 90% of us are engineers, so we love our quant models, and as Harish put, we love our heuristics and thumb rules. We try to find patterns in everything that we do. Uh, but again, as Harish put, I think those are curve fitting at the end of the day. We are just trying to fit patterns in an otherwise chaotic or random sequence of events. It could have taken n number of paths. It chose to take a path where we are sitting here today and talking to each other over a Zoom call or so, right? Um, but and nobody knew, let's say, about the coronavirus, etc. So it takes its own course, but we tend to fit patterns. Um, the first principles remain that for me are that uh, which is a tagline for Kotak, incidentally, is that you can't really time the market. As an asset allocator, I'm talking, and not as an equity bottom-up stock picking guy. I'm saying you cannot really time the market, and if you can't time the market, let's spend more time in the market, across cycles. You can put some heuristics there, because we all love heuristics. When you are uncomfortable with the levels, go slow. We all tend to do our SIPs, which is the most dispassionate way of investing in the market, a very mechanical way and the best possible way, I guess. But why can't we just maybe some put some rules there, like in these kinds of markets, troubled times, when everything looks really, really bad, and we all have been fed on Buffett's principles, that greed is good when everybody else is, you know, really fearful of the markets and everything. But the truth be told, when the markets fell to 7,600 about 15 days back, most of us froze, right? Despite all the WhatsApp gyan that we had ourselves been circulating, and the reasons are very simple. We all talk about this. Be greedy when others are fearful in bull markets. In times when everything is hunky dory. When we are speaking, when the markets are at 40,000 levels in Sensex, your jobs are secure. That is when we start discussing about Buffet principles, and that we should have invested. When the markets drop to 25,000, I'll invest. But the problem is when the markets actually drop to 25,000, your own job is not secure. Your own mortgages are not secure. The world seems to have collapsed, which is what happened, right? And then you freeze. So the best way to overcome that psychological, barrier is to become more dispassionate, and hence one, employ an advisor, and number two, make more mechanical as a process. There the mechanical processes come into come in really handy, and hence maybe increase your SIPs. So one, first things first, I think analyze your objectives, why you want to invest in the market or anywhere. Why do you want to invest first of all? What are objectives? Objectives can be retirement. Objectives can be, a short-term goal. Objectives can be just to optimize the cash allocation in your portfolio, that it is lying in a current account or a savings account. Can I earn some bit more on that? Objective can be that I want to really, my kid is growing up and I want to really create a corpus for him. Objective can be I want to go for my retirement. Objective can be I want to become rich. It can be an objective itself, right? But to be clear about the objective and be also ready to be on the receiving end if that objective or in that quest for that objective to materialize, it backfires, right? What I mean by that, in the quest to become rich, the only way to become rich is if you concentrate your risk, right? I mean, I don't know of any other way. Otherwise, you have to become a thief and money heist and all that will happen. But otherwise, it has to be a concentration of risk. So, for example, the ultra HNIs that I have always interacted with, they had concentrated their bets, made money, and then we are there to manage that money, right? So, management of risk is not creation of wealth, right? So, if you have to really become rich, concentrate your bets. Concentrate bets. You pick up, talk to Harish, take your bets on some of the companies, and you never know which way they will go. By the way, okay, it just make an informed opinion on those stocks or on those asset classes. You think the markets are going to go really, we're going to tank from here because you have a dead cat bounce, let's say, then sell your house, put money, short the futures, right? And if you make money, if your bet goes right, you become rich, then I'll come and manage your money. But if it doesn't go right, be prepared to lose your shirt and then again build up yourself. So that's the risk appetite and the objective that should be. I have no regrets on that. Okay. Or else, you start building a corpus. If you don't have that kind of a risk appetite, it's just like, starting your own startup. You had a very nice job somewhere, you left everything, joined a startup. One, it is because it's your passion. And number two, also you wanted to concentrate your bets on something else, right? So it's the same way. So risk versus reward is the first principle that I believe in. And second is time, and the basic discipline of investments. That discipline has to be there. You can't keep on jumping guns, jumping ships from, I got a tip from him, then I got a tip from somebody else, and I keep on investing in all those things. And this is a very common trait I have seen over the years with most of the investors. You will have a 90 stock portfolio which you have gathered over a period of 19 years, because Nitai told me one day to buy into this stock, I bought something. Then Sandeep told me I bought. Rahul told me I bought. Harish told me, "Arey, ye to karna hi hai," to maine kar liya. But in the process, I have built up 90 stock junk portfolio. And then when I go to a party, I'll only talk about the HDFC Bank that I bought, which is roughly 0.5% of the portfolio. But that has grown by 10 times in the last 10 years. I'll talk about that. Has that really created wealth for me? No. But that has created a lot of boasting quotient for me. So we need to understand how to rationalize our portfolios, and also need to know our own limitations. We are not, let's say a lot of us are not finance professionals. We don't understand a lot of stocks and we buy on hearsay. Let's not do that. You don't take a pill just because your friend told you to take that when you are not well. You go to a doctor to do that, right? So leave certain things to people with good intent. Understand one thing: finance is a very difficult profession because it's on law of probabilities. Unlike, let's say, a car salesman who is actually selling you a car which has defined features in it, so you know what all is there. You can easily compare a let's say a BMW 3 Series, and you know what are the features and what you want. In
Right.
finance, you don't know anything, right? You are more talking about probabilities, about what may happen in future. So what you have in hand today is your own risk appetite, your own objectives, your own corpus, and the discipline.
I'm
Rest
glad you
is
drew
all
that
luck.
analogy between your uh, medicine versus financial advice, because I'm tying
Yeah,
this to what you had said earlier about watch out for yourself, watch out for personal health, just like you do with financial health.
right.
So I find that very interesting as well. Um, Nitai, what are your views on this?
I agree a lot with what Sandipan had to say, and especially when it comes to having a process in place. And I think for me, it's very important. And part of the first principle is really to establish a process and stick to it. And when I say a process here, I necessarily mean deciding on an asset allocation mix. And then sticking to that instead of being very worried about what's really happening in the external environment. And one of the reasons why this has become my first principle is, when I see, large families invest, I look at the kind of time frame with which they invest. And for them, the money that they invest is really multi-generational, right? And obviously not all of us can afford to do that because we have our own challenges in terms of making ends meet and planning for our next vacation and so many other things. But I think broadly, what remains the same is that that there has to be that discipline in investing. So when you decide on, for example, X percentage of allocation to a particular asset class, and we'll talk more about asset allocation. I see there are a few questions on asset allocation on the chat as well, and we'll talk more about it. But just to give you a brief idea, when you decide about an allocation to a particular asset class, you don't really go to 0 or 100 based on what's happening in the market. The discipline is all about sticking to that asset allocation, obviously making a few tactical deviations based on what the markets are telling you, based on what the external environment is telling you, and not being completely inflexible about it, but also ensuring that you are where you need to be based on what your objectives are, based on what your asset allocation is, etc., and stick to that. Make slight tactical deviations, don't go to 0 or 200. That's a big first principle for me, at least. Despite what the market is telling you, if you're supposed to be, say, 40% in one particular asset class, be 60 maybe, be 50 maybe, be 30 maybe, be 25 maybe, but don't just go to 0 or 200 just because the markets are either too low or too high and they're telling you to do something. So I'm sure we'll speak more about asset allocation, then I'll probably expand on this a bit.
Sure. The one thing I find notable is when at the beginning you said you look at the time horizon that with which family offices invest their money. One family office that I'd spoken to from Central America, one of the things they had said was family money is patient money. And they're saying, look, it's like a little bit like those wheels of justice grind slow, but they grind exceedingly small. They're saying we'll take months potentially to evaluate and invest, but when we do, we'll do it for the long term. So that's notable. The other thing also is why we talk about first principles and asset allocation. So my personal experience with signing up with a wealth advisor a few years ago was that for the very first time in years, I was reading the news for what it is. In a sense, I was not constantly thinking about how it impacts my portfolio. I think someone else is worrying about it now. Now that was a long time ago, but I still remember how it felt on that very first morning after saying someone's managing it. So all of the questions about asset allocation and the specifics is something that I had outsourced. As long as, like all three of you have said, the discipline of investing is something that is something that's always going to be up to you. Anyway, Sandeep, what do you think about what these times mean for investing, both in real estate and in allied areas? And what are your first principles of investing?
So all three panelists have given very good first principles of how to look at investment. Coming to real estate as such, unlike the previous generations or our fathers or their fathers, real estate generally has been a large portion of a family's wealth, right? And over a period of time, in the last, I think maybe a decade, that has changed dramatically. Real estate returns are not like how they used to be, because capital appreciation has just gone out of the picture, right? Over the last 5 years, I don't think prices have increased anywhere. In fact, they've decreased. Rental yields have been abysmally low. So as an investment asset class, residential asset class, real estate has taken a big backseat, and that's why I think the whole financial industry is taking has got a boost, right? The SIPs and everything, because the asset allocation has moved from real estate to asset class, and it's driven by majority of the policies and all of those things, right? So, so as such, as an investment class, residential is not, I think, on top anywhere now. It's still a aspirational home ownership that is uh, that would still take a large part of your wallet, whoever it be, right? As a professional, unless you are a super HNI, your assets will still be heavily skewed towards real estate, because you will put a lot of your savings, you'll take a mortgage, so it still will take a lot of your wallet share. But from an investment perspective, I think it has declined over the last few years. Commercial real estate, wherein the yields are much higher, has come up as a good asset class. However, it has largely stayed away from uh, uh, maybe professionals or smaller investors. It's largely been a HNI or an institutional category. Uh, there are some companies which are trying to work on getting that ownership base on commercial assets more broader. I think that could pick up over time. So that's my view on real estate as an investment class, right? Mm, we'll see how other panelists will talk about asset allocation, and we'll see how real estate would be in that segment.
I thought, while we're going to get to asset allocation right after this, and then we have a question for you, which is, saying, does correction happen in Indian real estate, or do you expect it to happen, or do you expect
Yeah. So correct.
promoters
If
to come?
you go into any real estate panel, and it will show up that Deepak Parekh ji said 20% correction, right? And in fact, I was on that panel, and there were close to maybe 10,000 people on that webinar, and there were 10,000 people, and every developer, when they heard Deepak Parekh say 20%, started crying. Sir, what are you saying? Why are you saying this? Uh, uh, but my view is that pricing is a far more nuanced thing. It is not as if you say 20% and every project is like 20% discount, right? There will be, there are pockets. So there are, city level trends. Then there are locality specific trends. There are premium versus non-premium sets. So I think pricing correction will be largely in, say, cities like Mumbai or Gurgaon, and will be skewed towards maybe premium projects. In my view, is that, so basic maths, right? So construction cost is close to 3,000 rupees per square feet. There is a sales and marketing cost of anywhere between 5 to 10%. So if a project is priced between 6,000 to 10,000 per square feet, there isn't enough margin anyways. So price reduction would mean losses, right? And I think there will be some developers who would still take losses in the current environment, given the cash flow position. But as such, the margins do not have enough cushion for a large price discount in projects where there are pricing is between 6 to 10,000, which is, say, a Bangalore or a Hyderabad or a Chennai or a Noida. So I think pricing corrections will be largely geared towards premium projects and in locations like Bombay and Gurgaon. But as I said, there is no thumb rule. You can't say 20% off and everything is at that discount.
Got it. Got it. So, I think one question that we keep getting asked at Cube Wealth is, when we're adding property to our list of asset classes that we offer, specifically these fractional property ownership services. You just alluded to them when you were talking about commercial real estate being made available to retail now. I'm assuming it's via channels like this. What do you think of that channel in the first place, like fractional property in general?
So, just a disclaimer before I start saying good things about it, because we are an investor in a company called Strata Prop, which enables fractional ownership in commercial real estate. So, so I think it has picked up over the last 18 months, and given that there is institutional funding support as well, this will gather pace. Unfortunately, because of this whole COVID thing, a lot of deal making will is at a standstill, right? So I think, given that sector, right, if the yields are higher, it is much higher than an FD. It is backed by a good grade A tenant who's paying rents, and will be far less volatile compared to any other competing asset class, be it stocks or whatever, right? So stable, much higher yields if you're taking a good tenant who's the underlying, the risk that you're taking is the underlying tenant risk, right? And so if that is in place, I think it's a good asset class, because if you're getting anything between 7 to 9% as yields plus a capital appreciation of say even a 5% a year, your annualized returns are close to 12 to 13%. So, and these are stable, not volatile as such. So I think from that perspective, there was, I think we'll have to see how it will be post COVID, but there was some significant interest in such an asset class, largely from the I don't know what the term is, but maybe mass affluent segment uh, that has emerged, right? So I think it's here to stay. There will be, as you said, post COVID, I think there will be some pressure on the rentals. But I think this asset class, given the stability, could get some kind of a asset allocation over the next few years.
I think we should move on to asset allocation, which we're getting a lot of questions about in general. Nitai, why don't we begin with you? What are your opinions on the question in general about asset allocation? And feel free to answer the question about crypto and Bitcoin that was asked as well.
So sorry, that was for me, right? Somehow I got okay. All right. So please bear with me, because I think this is a topic which is close to my heart and my profession. So I might be slightly more detailed than on the other questions. So please bear with me here. But I think it's very relevant.
You've raised their expectations, so deliver
now. Okay, I'll try that. So like I was saying, it's not just about looking at risk and return numbers, but it's much more nuanced than that. It's more about the kind of goals and objectives that you have, right? So you start with something as basic as creating a safety tip or a safety portfolio, which is really, like Rahul said, I think a little earlier, something which is for contingencies, something that you need to ensure that you have money when you need it. How much that should be, whether it should be X months of salary, whether it should be X percentage of your portfolio, is something which every individual has to decide. But broadly, this part of the portfolio is something where you don't take any risks. This part of the portfolio is something which you keep for any kind of a situation where you lose your job, where you lose your livelihood, where you don't have any other way of making money. That's when you dip into this part of the portfolio. As a thumb rule, and again, I agree with Harish that there should not be thumb rules, but as a thumb rule, most HNIs, most family offices look at about 20% of their portfolio into this particular goal or this particular pool. Now, when you decide on a pool, what happens is really that your asset allocation for that pool, just by the objective of that pool, is defined. So when you're talking about something which is a safety pool, obviously your asset allocation is going to be completely fixed income, no credit risk, no interest rate sensitivity, and all those kind of things. Then you may have something which is like a lifestyle objective, that you want to maintain your lifestyle, whatever you're used to today, you want to maintain that lifestyle over a period of time. What is important there is to have a portfolio that can actually beat inflation at all points in time, and have something which is actually growing at the same pace at which your objectives are growing, at which your lifestyle objectives are growing. You have a balanced portfolio, obviously by definition, to meet that kind of a need. Then you may have a growth kind of objective, something which Sandipan alluded to, where he said that you may want to become rich. Now, if you want to become rich, you want to have growth in your portfolio, and for that you need to take a different kind of risk. So that's a profile, or that's a pool of your portfolio for which you may want to invest in, direct equity, you may want to invest in high growth alternative assets, you may want to invest in venture capital, you may want to invest in development real estate. So there's so many other ways of doing that. So what I'm trying to say is that there is no single asset allocation that any of us can and should have. It should always be divided into the kind of goals that we have, and for each goal, you need to have a different portfolio. Now, within that portfolio, by the definition of the goal, you'll come to know what's the kind of asset allocation that you should follow. And once you've decided on the broad asset allocation for each of your goals, then within that, you then talk about the sub-allocations into different kind of product vehicles, into different kind of asset classes. So for example, if I'm looking at a lifestyle portfolio, I may look at equity through mutual funds and exchange traded funds, where it's, I'm really relying on the skill and diversification which are brought in by mutual fund managers and the indices which are there on the market. I may look at something which is a high yield debt portfolio. So, like Sandeep was saying just now, maybe get into something which is giving me fractional ownership of real estate and giving me a total return of say 12-13% per annum, right? Have some allocation to that. If I have the kind of money and the scale, I may look at some other high yield debt opportunities. Today, there are so many high yield debt opportunities which are available where people are trying to discount business receivables and selling those. There are so many sharing economy businesses where you can actually be an owner of the assets that are being leased out and make money on the lease rentals that are received from the individual customers. So a lot of these businesses, obviously, or a lot of these investment options, obviously, are I think with time and with new ventures such as Rahul's and what Sandeep was referring to, a lot of these ideas are also going to come to retail investors like us. So we should be open to those kind of ideas, especially for our lifestyle portfolio, right? So these are the various things that I will look at instead of looking at one single asset allocation. And when I've decided on these different asset allocations, I won't really normally tamper with it too much. So for example, if 20% of my portfolio is going to be with the safety pool, just because there's been a market fall or a market rise, that's not going to change. If there is 50% of my portfolio which is in my lifestyle pool, that's not going to change too much. Yes, within lifestyle, I may decide to tweak my equity allocation a bit. I may go higher on debt, based on what the market conditions are. But it's not that from 20% to safety portfolio, I'll go up to 50% on the safety portfolio just because something has happened to the markets. So I think that's really my approach to asset allocation and what I've seen work very well for family offices as well. And just the last point before I conclude, one is this entire asset allocation, which is more systematic and something that you need to follow all the time. But then to specific asset classes which act as hedge against what's happening in the economy or in the world broadly. So gold obviously is a very important hedge because the currencies across the world will no longer be what they used to be, and gold will be for at least for the near future. Having said that, we should not really confuse these asset classes with long-term allocations, because most of these asset classes are really temporary hedges against what is happening or hedges against risk. So we should look at investing into them at this point in time when there are uncertain times like these, but then get out once we are back to status quo or back to a stable kind of investment economy. So that's really my 2 bits on asset allocation and allocation to some of the asset classes that we've been asked on.
Okay, all right, that was cool. Thanks a ton. So again, at what you said about having different portfolios for different goals and allocating them differently is something we hold as core to the approach that we take as well. What you said at the end about using assets such as gold and other alternatives as hedges, but then being able to get out of them reminded me, Harish, of an interview you'd given on a TV channel sometime in September or October last year, where someone had asked you this was about in regard to the funds that you manage. You're saying entry to sabko aati hai, but when do you know when is the right time to exit? And I remember you said no one has a crystal ball about it. So whether it's about using alternative assets such as gold to hedge, but then knowing when to unhedge, or whether it's the question that you are asked in general about entry and exit, because that has a direct impact on your asset allocation as well. How do you deal with the fact that there is no crystal ball? You still need to figure out when to enter and exit.
So it's good that somebody watches all that is shown on TV. It's a pleasant surprise. Maybe I'll try and answer from a slightly more different perspective to what Nitai gave, because clearly asset allocation is a personal choice. It is defined by goals and objectives that each one of you have. But it's also important to see the mirror of the average Indian household to get a sense whether you are part of the crowd, or are you different from the crowd, or are you going to be materially ahead of where the crowd will eventually move to, say, 5 years or 10 years down the line. Just bear with me while I throw some numbers, and then I'll come to the point as to how I decide when it makes sense to get in and get out of an asset class. And this is a personal choice. Firstly, and this is something that I've spoken to quite a few of you before as well. There's a very nice ratio given by Thomas Piketty in his book, which is known as the global wealth to income ratio. Effectively, the income is the profit and loss statement, and the wealth is the balance sheet number. So, for a personal individual, an income would be the salary one draws, the dividends from the stocks that one has, the interest from the debt papers one has, and potentially the rents that we have from our houses. Right. So that is the income flow, and the wealth is really what the denominator is, what your overall net worth is at any point of time. And the global wealth to income ratio is somewhere around 5 to 6 times. So effectively, if you're earning 10 lakhs, the average or the median guy, and I'm not talking of Jeff Bezos or Bill Gates, we're talking of an average American or a median American would be 6 times. So $100,000 or $50,000, let's say, is a median income. We're talking about close to about $250,000 to $300,000 as his wealth accumulated over a period of time. Now, in India, that number is close to about 2.5 to 3 times. Okay, so if an average Indian is earning 10 lakhs, his average wealth that is accumulated over time is close to about 30 lakhs. Now, obviously, each of us can decide where we are, but the clear thing is, how is this 3 times wealth distributed in India? Right, and because that has material implications in terms of how asset allocation works for the country as a whole. So currently, again, I'm just switching and making some approximations so that it's easier. So we currently say a $2 trillion economy, hypothetically. Our wealth is close to about $6 trillion. Basis this math. Out of the $6 trillion, close to about $1 trillion is in agricultural land. Okay, urban land, which Sandeep spoke about, which is a great demand, which is part of most of middle class households, is close to about $1.5 to $2 trillion. So real estate accounts for almost 50% of our wealth. Right now. Keep in mind that urban India accounts for 8% of overall India. So as a proportion, urban India is actually a very small percent of the overall, landmass that is India. You've got gold, which is $1 trillion. You've got fixed deposits, which is close to about $1 trillion. You've got insurance, which is about $500 billion, and you've got equities, which is currently close to about $200 billion. Okay, so and then of course there is some rounding of elements. So effectively, if you try and see how the US wealth is distributed, close to about 50% of his wealth is in stocks and stock related instruments. We are at currently about 2 to 3% of our average wealth, which is into stock and stock related instruments. So therefore, while it is a personal choice about asset allocation, one also needs to keep in mind what the bigger picture trend is going to be. Say 10, 15, 20 years down the line, is that 2% likely to go to 5%? It may not go all the way up to 50%, but can it go to 5%? And then would you want to be ahead of that curve, or would you want to be behind that curve? Now, coming to your question as to when to sell, clearly there is no crystal ball. And one way that has worked very well for me, especially when it comes to asset allocation, has been rolling returns. I think this is a concept which is the most basic concept that personal investors need to understand. This is 101. Unfortunately, I got to know of it only say 5-6 years into my professional life. But I wish I had known this while they were teaching MBA. Rolling returns is the simplest thing, and I urge all of you, if you have not looked at it, to look it up online. What is the simple concept of rolling returns? And every asset class broadly has got a particular band of rolling returns, and we can have a separate discussion as to why gold is having a rolling return of X, and why equity has got a rolling return of Y, etc. That's a separate thing. But if you do the math, it becomes plain and visible for you that each asset class has a particular band of rolling returns, right? Now, when you got, say, the last 3 years or the last 5 years rolling returns of equity at 0%, and the average over the last 20, 30 years has been 12, 13%, to me, it is a huge contrarian signal that was the next 5 years, equity is going to do much better. And therefore, I would be, so within the band that Nitai spoke, clearly everybody has got a band. I would be overweight equities from that perspective. So if 40% is what I have decided as equities, I would be 50%. To put it in Nitai's perspective, it doesn't mean going all the way to 100%, right? Similarly, if gold, which is typically supposed to give, say, a 4-5% kind of a return, has suddenly spiked up to give, say, a rolling 3-year or a 5-year return of 10%, that possibly it is an extended thing. That doesn't mean I'll make it to zero, right? It means that from where I am, I move into, say, -2 or -3% from where my original thing. So I think this rolling return, to my mind, works as a much better gauge, rather than trying to be astrologer and see where corporate earnings will be, where GDP will go up and all that, because it's just too complicated. Nobody has got a clue. So best to look at simpler heuristics and thumb rules, and the best thumb rule, I think, is rolling returns, because it's so mean reverting over a long period of time. Sorry, I took a lot of time. That's it from my end. Thank you.
No, I think it makes a ton of sense. So we talked about getting in and out and asset allocation from that point of view with you, but with Sandipan, I just want to return to something you had said earlier, which is when you talked about how people end up accreting their portfolios over time, either based on some work they've done themselves, or more likely, unfortunately, based on hearsay and tips from people that they come across. And eventually they build a large, over diversified portfolio, but really what they pay attention to is an extremely small part of that. How do you personally deal with the problem of diversification? And the other thing that I'd also like you to touch on, if you can, is how do you, now there are opportunities for people to geographically diversify as well here. So how does that play a part, if at all, for yourself?
Just another point on asset allocation before I get into this topic, is that another very important thing that works for all of us, especially in India where the taxation rates are quite high, is the tax part. So we need to look at each asset class from a post-tax return perspective, because in the end that is what you get, right? And somewhere I feel let's say somebody had written a comment on FDs, etc. You need to weigh the options on a post-tax basis. If you are, let's say your dad is investing in an FD and his taxation rate is 10%, I think it's a brilliant asset class to invest in. If you get a corporate FD, which is what is suggested, of say HDFC Limited, I think you just invest there under 10% tax. Fantastic. But imagine you investing in an FD of 7 or 8%, and the government taking away 40% of it as tax. Then what is your risk-adjusted return? Uh, the other way to look at it is, suppose you are getting 8% return. There are two instruments. One is giving you a gross return of 12%. The other is giving you a gross return of 9%. Now, an asset which is giving you a 9% gross return to deliver a post-tax return of 8%, just imagine the risk it is taking vis-a-vis an asset which is delivering a gross return of 12 or 13% to give you the same post-tax 8% return. So per unit of risk for the same post-tax return is far higher in the second asset than in the first. So you need to weigh those options as well. Always be mindful of taxes or your post-tax returns, because in the end that is what matters. So your entire investment decision should also always include tax as a part of your of the entire process of calculations. Um, uh, on the question on how to rationalize portfolios, I think again, most of us human beings, we like patterns, we like heuristics. In the end, Harish also considered about heuristics. So I would say that, yeah, we all want to have some patterns in life. As Morgan Housel had said recently, that history doesn't have patterns. We human beings have patterns, and that's what we try to fit in the history. But the thing is, if we just go with that logic, then let's keep some rules of at least yearly visit into your portfolio. Try to weed out the junk. There's always a core portfolio and always a tail portfolio. Anything, for example, let's take a simple stock portfolio, the example that I gave you of 90 stocks. You will invariably find the Pareto principle working out there. You'll find that there will be 20 stocks, which will be 80% of the portfolio, and then there will be 70 stocks, which will be 20% of the portfolio. So either, all those 70 stocks have to really do well, or you really need to be in those stocks at all or not. You need to find that out. So that is the code to tell and the impact of each stock on your portfolio that you rationalize, and then you either weed them off or you increase their allocation. Simple. Same works when you are looking at your mutual fund portfolio, I think, which is very relevant for all of us. We all tend to have 13, 14, 15 equity mutual fund portfolios, which are all, let's say, diversified. Just look at the portfolio, you will find that you will end up having anyways an 8 to 10%. If you just collectively add all of them up, you will find that you will have 12% in HDFC, you will have 10% in ICICI Bank, you will have a 7-8% in Reliance. And then you look at your direct stock portfolio, maybe you are mirroring the same thing. So does it really need to replicate the same portfolio or not? Or does it really justify it? That you then take a call. Okay. And within the mutual funds, again, just see that whether having 15 mutual funds which are all replicating the same strategy really make any sense for you. Okay. Or does it actually make sense to have, each segment wise, you pick 3 or 2 mutual funds and try to stick on to them, because as we all know, every fund manager has his cycles. So you need to pick up funds which are complementary to each other. A Prashant Jain, who invariably will end up with an SBI, an Axis, an ICICI, an L&T, a very high beta infra or a rebound oriented portfolio, vis-a-vis a Shankar Narayan who will be far more value oriented. I mean, I would rather have these two together than having two out and out bull guys having the same portfolio in my mutual fund portfolio. That's where I am creating redundancies in my portfolio, right? And nothing else. Third thing, obviously, you have to look at is taxation and load structures, so that even if you want to exit, you will have your taxation in mind. Does it really, let's say you have not yet completed 3 years in mutual funds. So do you really exit out of that debt mutual fund? Becomes a very interesting call, especially in today's scenario where credit funds, a lot of corporate debt funds have seen a lot of turmoil. You'd have to do a cost benefit analysis. Let's say you have a Franklin Templeton short term income. I did this kind of analysis very recently for a client, and you have about 3 or 4 months left to complete 3 years, and you are, let's say, having a 27% return. Now, if you exit now, you end up paying the full marginal rate of taxation. And if you just wait for 3 months and then you exit, you end up paying an indexed 20%, right? So you then find out that if I weed out complete 20% of the portfolio, 10% of the portfolio, am I still better off holding for the next 3 months because of taxation, as I had highlighted before, and then exiting than exiting now? Okay, so that then becomes another point of decision making. So that is how generally I also approach my own fund portfolio and try and look at things from a more pragmatic way. The way I will approach my client's portfolio is the same way that I'll approach my own portfolio. Uh, Coming to the lot of questions on gold, Nitai covered it a bit, but unfortunately his voice broke in the middle. So that's where I would also chip in just with my points. I did some calculations on gold, and that also becomes very interesting as a data point. In 1930, gold was about $20.6 to an ounce. At that time, gold used to be pegged. I mean, dollar used to be pegged to gold. Okay. So $100 would have bought you 4.85 ounce of gold. Okay. Come to 2020, 1700 approximately is where gold is today, and 1500 or 1494 is inflation adjusted $100 in 1930 today, which means $100 of 1930 will be 2020 $1500. So imagine today that $1500 can only buy you zero point 0.9 ounce of gold. So gold as an asset class has actually helped you not only preserve your wealth, but actually multiply wealth by more than 5 times, being an asset class which doesn't yield anything. Okay. So to that extent, I think gold becomes an important asset class. I have my other points also that somebody also highlighted in the chat, a very pertinent point, that central banks have been easing on an easing spree, and in those kinds of scenario, I think low yielding asset classes like gold, they tend to do very well, and they will do well. Then obviously there is a rise in government debt. If you look at history from the World War II perspective, I think the debt for US went up to as high as 160% of their GDP. And from there on, obviously, what they did was two things. Again, in the Morgan Housel commentary we recently shared in the WhatsApp group also, it was very interestingly pointed out that while human beings have finite life and hence we have to pay off our debt, for a government or a company which is infinite life, you just need to outgrow that debt, which means your debt to your revenue ratio has to fall down. That is all you have to do, right? But more importantly, what US did is they inflated out their way out of debt. When you create an inflation which is really high, your real rate of return goes down, and hence the effective debt that you have goes down. So right now, given the high amount of debt that the governments hold, or are going to hold, given the amount of fiscal stimulus that is going to happen across the central banks across the world, I think there are three options. One is either you default, but if you default, obviously that if you default, that I mean that can be an option for a country like Argentina, but cannot be an option for a country like US. Um, and especially if you have a hard currency like India, where most of the debt is domestic debt, I don't think default is an option anyways. You are only defaulting to your own countrymen then, which you will not do, right? Uh, Number two will be then you increase your taxes and in revenues and then try to repay the debt, which is again not so pleasant a scenario for the ultra HNIs and the corporates in a dwindling revenue scenario. Third will be to inflate your way out of it, which is the most plausible way, which is where spendings will increase, and at some point we will want to have inflation coming back, and that again is something which is good for gold. Number three obviously will be let's say a weak dollar, which is, I think dollar has more or less peaked where we are. 95% of gold demand is outside of US, and about 70% of it is consumer demand, which is again China and India mostly. If that is the case, I think with a weak dollar, gold always has a negative correlation, and gold will have its own views. And fourth, I think if central banks buy, all central banks, just imagine if they make 10% of their reserves gold, that itself increases gold demand by double of what it is today. So, that itself is about 6,500 tons of gold that need to be bought by the entire world then, if that is the kind of thing. So gold, I think, has its points, and hence it becomes a very, very interesting asset class to hold. In India, especially where you have gold bonds, where you have a 2.5% yield that you are going to get, that means you are getting an asset class at a PE of 40. And most of the stocks today, the good quality stocks are at a PE of 40. So if I imagine from that perspective, also a wealth store you are getting, an insurance you are getting at a PE of 40, I think it makes a lot of sense to have it as this 5 to 10% of your portfolio in gold. So that just covers the gold, the rationalization part. And in terms of offshore, I definitely think, and thanks to all the AMCs like Kotak or a Franklin or a JP or even a small guy like Motilal Oswal, we have fantastic avenues. We don't need to really go through the liberalized remittance scheme or an LRA scheme. A lot of our alumni obviously are anyways based out of India, and they have it easy. But for guys like us who are in India and who don't want to go through the rigmaroles of LRA scheme of RBI, etc., to send dollars abroad, I think the best way to invest is through these offshore feeder funds. Uh, I think the world is at a stage where you have to invest in an US equity market. It's not just about emerging markets like India. I think the innovations and the capital raising maximum happens in US. Next will be China, and you need to be invested in these two countries for sure. And the best way to do, unfortunately, China, we don't have many options today, but I'm sure, Harish, if you can work on such a feeder fund structure from Kotak, there will be takers for that. But for US, there are. And, especially on the tech side, I think, if you want to own a company like Amazon or a Google or a Microsoft, etc., best way will be to invest in an ETF. Motilal itself has an ETF called NASDAQ ETF, which I have been a very strong proponent of since 2012 when they had launched, 2011 when they had launched it. And I firmly believe in it. I think that becomes your offshore allocation sitting in India. All these offshore feeder funds like Franklin US Opportunities Fund or a JP Morgan US Value Fund. Uh, so there are myriads or hosts of them. Just look up, those mutual funds which are there. They become your automatic. And the beauty of this is that you don't need to have any LRS limits, etc. You can put as much money in that, and you are creating your own currency locking system by the day you are sending the money abroad and the day you are redeeming. So it's akin to just putting dollars outside and then bringing it back. It's the same minus the costs. So mutual funds anyways become the most hassle-free and most efficient way of putting money abroad, according to me.
Nice. Okay. No, it's good to know that, because the LRS process, regardless of how simplified it is still a lot more cumbersome than, say, buying a mutual fund. Okay, so Sandeep, I just wanted to touch on asset allocation with you as well, given that, as you yourself pointed out, real estate turns out to dominate most people's asset allocation quite often throughout their lives. How do you deal with it? How do you think people should deal with it? What's a good approach to asset allocation when you consider real estate as well?
So I think, given the times we are in right now, these are challenging times. Given when income stability comes into picture, real estate as an asset class, becomes a difficult decision to take. However, given what I saw in the last cycle, when the financial crisis happened, uh, if you have a sense of job security, and if you see that prices are low, interest rates are low, you know these are the best times to buy, and that's practically true for maybe every asset class where prices are lower, right? So from that sense, I think these are the times when you should look at such a decision. However, it is completely dependent on how your income stability is as of now. uh, and from a perspective of what you should be looking at, I think we are in a market where ready to move in inventory is at a lifetime high, right? Most projects are ready and are unsold. So as a customer, if as a person, if you're looking to buy real estate, I would strongly suggest, do not take execution risk right now of a project getting completed. There are enough projects that are complete. So if you're looking at it, that's would be my first advice. Second, if your cash flows do not allow you to purchase a ready property because your EMIs will start immediately and all of that, you should look at a good developer. A good developer is actually a misnomer as such, but I would suggest look at look at developers who are, say, a corporate group, maybe larger developers. Larger developers have, I think, have seen cycles and have a larger project portfolio, so they can take calls like, I'll maybe take a loss on this project and make money later here. But if you're looking at single project developers or smaller developers, they're a strict. I would suggest strongly stay away from them as much as possible if you're looking at a new project. And so that's how I look at the space right now from an individual perspective. You know, if you, as I said again, to summarize, if your income stability is there, these are right good times. Look at ready projects. Look at a price discount. Take advantage of the low interest rates. Maybe wait for a couple of quarters. Don't take decisions immediately. Let's see how this COVID thing pans out. Governments are every government practically all over the world, and including ours, they are looking at this. In fact, every sector closely and trying to see how to revive them post COVID. Real estate will obviously need stimulus, given as you all know would employ so many people. So how do you get buyer demand back? So there could be some announcements, but as I said, let it play out over the next 2 quarters, and if you see that you are stable in your jobs and all that, good time to dive in.
Nice. Okay. So, guys, because we're so very much over time, there are going to be a few excellent audience questions that we're going to have to leave unanswered. So there's one about PMS versus actively managed funds. There's one about the potential for holding US dollars as a currency hedge. Then there are other specific questions about gold and about real estate. But we're going to have to leave those unanswered at the moment. Quick question that was asked though about investing in Bitcoin really early on. Let me just take that for a second. I've been a huge enthusiast of what decentralized technology makes possible in various sectors. Forget the whole cryptocurrency angle, but the whole quote unquote blockchain thing in being able to create new use cases, new ways of doing business, and so on. Right. So, in terms of investing in Bitcoin, look, I'm of all of the people on the panel, I am the least qualified in general to give advice on any asset class, leave alone crypto. But here's the way I look at it. It's a very non-correlated asset class in that it doesn't move along with Indian stocks or US stocks or any other asset class among the ones that we've discussed here. But non-correlated doesn't mean that it's a hedge, because there's really very little you can do to predict the way it moves. Until we get to a point where there are tokens where you have regular assets that are tokenized, or you have cryptocurrencies that represent actual projects or products or technologies that make new things possible, it's all entirely speculation driven. So invest literally at your own peril. This is play money. So go for it, but don't expect it to don't make it your plan to get rich at all. Like, if it does, great. If you invested in Bitcoin in 2011, enjoy your Lamborghinis. But other than that, no. Right? So that's where it is. What we'll do very, very quickly, guys, before we wrap up, is I just want to hear from each of the four of you on, like, literally in one sentence, potentially. I know that's doing injustice, but literally in one sentence on what you think the quote unquote new economy is going to look like once all of what's going on right now is done. Harish, you want to go first?
Okay, at the risk of sounding dumb, I think it's going to look pretty much the same as it was the last 125 or 200 or 500 years. We are over imagining a disruption. Yes, might take about 6 months, it might take about 12 months, but then if you're investing for the long term, I don't think it should really mean a lot from a bigger asset allocation point of view.
Got it. Sandeep?
Yeah, so completely agree with Harish, and I think it's just a matter of a few months or maybe max a year till that vaccine, the magic vaccine, is there, because I think we are all fearing this, and this fear will persist till that time, post which things will recover. Uh, if you are liquid enough right now, these are these are times you play out the, get into the markets, be it stocks, be it real estate, wherever. If you're liquid, things will get back to normal sooner than later.
Cool. Nitai?
Well, I think the basics are going to remain the same, like everybody's just said, and nothing's going to change there, and things will revert to normal pretty soon. It's just that there will be some trends that will start emerging, and any situation such as this has got some impact, while it doesn't really change the fundamentals of investing, but it has some impact in terms of the kind of trends that emerge. So, look out for sectors that may become more relevant going forward, and people who are investing in that space will become more relevant going forward. So things such as contactless, services, things such as local manufacturing, given that China will obviously have a tough time being what they used to be. There is a big opportunity for Indian manufacturers now to take over the global demand, which will probably not move away in a big way, but at least there'll be an opportunity for other countries, especially in the Southeast Asian region and India, to really make an impact there. So look out for people who are doing businesses in those areas. Look out for delivery companies, grocery companies. Look out for the local supermarkets. So I think all those are also going to become very important and relevant going forward. So look out for trends.
Trends. Okay. And Sandipan, what do you say?
Yeah, I think I'll give you just one interesting data point. IMF says China is going to grow by 1.2% this year, which is disheartening. The same IMF says, under the same calculations, in 2021-22, China should grow by a mind-numbing 9.2%. Okay, so that itself shows us, I think it's IMF saying, not me. Okay, and I think life moves on. Life will continue the way it is. One trend that will emerge, I think, large will become larger, which has been a secular trend in India, given the way government has clamped down on a lot of practices. So big will become bigger worldwide. Technology will gain. It's for us Indians to squander the opportunity that has been given to us, as Nitai rightly pointed out. So it's for us to lose rather than for others to win from here on. So India actually has a great story going forward. Let's all walk towards it. That's all. Thank you.
Okay, cool. I think I'm glad this has been so reassuring coming from you guys. It's really what we've been telling our customers as well, which is, as long as you've invested in great asset classes and have invested it under great advice, then as long as you've ticked off all of your basics, like your emergency fund, you've got enough insurance, you've been saving for your goals, and you've thought about the objectives, then just go for it. This is more a period of opportunity than it is really of fear. So thank you guys. You guys have been an incredible panel. The audience clearly has been extremely engaged. I'm glad we were able to work in a lot of their questions. Thanks a ton.
Thanks, Rahul. Thank you for the great moderation as well. Thank you so much.
Yeah, thank you.
Thank you.